everybody
I don't know
else?
how this, I don't
Okay,
know
I
how this
think we're
stuff
good.
works.
Yeah,
Eric, can you hear me?
I can hear you.
okay,
Beautiful.
great. And then we'll keep an eye out for admitting anybody.
Perfect.
Okay,
All right, we are gonna start with, Mortgage 101 here. We're gonna talk about a few different things, guys. If you have questions, please ask them. Eric, make sure you're asking questions too. This is gonna be just like a really broad overview of things. You know, how a pre-approval process works and whatnot. So, we'll start with that. So how the pre-approval process works. So you're going to find as you work in more, as you work in real estate, that the pre-approval process is different with every single loan officer, okay? There are loan officers out there, and sorry, I'm gonna be talking directly to you.
I'm okay with it.
So, you know, there's gonna be a lot of loan officers out there who don't verify documentation, but will put their name on a pre-approval. That's something that you wanna avoid like the plague. And there are loan officers who are very thorough and verify things. A true pre-approval, in my opinion, means that it is something that the loan officer has reviewed their income documentation, meaning that they have the money to qualify, their asset documentation, meaning that they have the cash to perform this transaction, and that they are credit worthy. So they reviewed their credit. They've reviewed all those things, they've examined it, they have made sure that barring something unforeseen, you know, like the borrower losing their job, or the borrower lying and they didn't catch it, barring those unforeseen things, we are closing that loan. That to me is a true pre-approval. I know that's how we operate within the Rife group, is we make sure that we do that. You know, you have to make sure that you're working with the right people to make sure that they're doing their job correctly, because there are some lenders out there, national lenders, who I could go on their website right now, you could go on their website right now, and you could put in whatever you want. You could say that you make $300,000 a year, and you have $200,000 in the bank, and your credit score is 800, and they'll just give you a pre-approval letter without verifying anything. That is crazy. So that's why it's very, very important to vet who you are working with, because working with that is not good. So many bad experiences are created by loan officers not doing their job correctly up front, okay? We don't want to create bad experiences. We want to do our jobs correctly up front to ensure that's a smooth transaction. How I work transactions is before someone even gets under contract, I am examining every which way possible that this deal might fall apart, and I'm mitigating it up front. And knock on fake wood, I'm batting 100, or batting 1,000, never not close.
Okay.
And that's because we're very, very thorough up front, and that's very, very important. So during that pre-approval process, you know, like I said, we're verifying income is a big thing. And you know, income isn't as simple as just, oh, I make this much and this is what your pay stubs say. We have to make sure that we can utilize it. So let's say that, you know, I've got someone who, you know, they're self-employed. They make, you know, on paper, they make $200,000 a year. Like they can show me their P&L and everything, and that's great.
Sure.
But then I look at their tax returns and they wrote off all their income. Well, now I can't use that income. So that's why it's very important to just verify those things before you even send them out. And your guys' most valuable asset for you is your time, right? And time is finite. So you want to make sure that your time is being allocated with folks who are actually pre-approved and ready to go, because you can't get that back. So it's just very important to, again, just partner with someone who is, and it doesn't have to be us, we'd love it to be us, doesn't have to be us though, that is doing their job very, very thoroughly and correctly up front. Because we don't want you wasting your time, we don't want you guys wasting the buyer's time, we don't want you wasting sellers' time. I mean, you're gonna have listings, you know, at some point that have gone on, and unfortunately the loan officer didn't do a good job, and and the contract fell through because the loan officer didn't do a good job, and your sellers are gonna get punished for it. Because they're gonna have that stigma of going back on market, and your sellers didn't do anything wrong. Simply just because the loan officer didn't do their job. There are times that things are gonna happen. A buyer's gonna lose their job. No one can help that. That is what it is. But I would say 99% of the time, if a contract doesn't go through, is more than likely the loan officer's fault. So that's why it's very, very important to just work with people who are very, very good at what they do. Income can be tricky, and a good loan officer is going to ask for things up front, and they may ask for more things. And if they're asking for more things, it's because they want to, they see a problem and they're trying to solve it. I have had clients in the past get frustrated with me, and they're like, why are you asking for this? No one else has asked me for this. Well, I'm asking you for this because I'm seeing a way that your loan may not close, and I want to make sure that that doesn't happen before you even have a contract. So a lot of questions up front is a good thing. A lot of documentation up front is a good thing because we are really, really protecting that pre-approval by doing so. We get someone pre-approved, right? I just threw a lot at you. What questions can I answer based off of just pre-approval stuff?
Yes, so going back to the, a person makes $200,000, but they wrote off, let's say, 150 of that. So the consideration is the 50 remaining, not what was written off.
Correct.
So the banks don't see potential, they only go by what they're working with at the end, right?
Correct.
Not the write-off amount.
Correct.
Interesting.
And there are such things like bank statement loans, which show only money in, money out.
Okay.
And those are products that are really, really popular with self-employed borrowers. So there are other products that can aid in that scenario. But yes, we do have to take into account what the actual taxable income is on a tax return for a self-employed borrower.
Yeah, for self-employed, okay.
Any other general pre-approval questions before I dive into the next one? I know I just let off with like horror stories, I'm sorry.
No, that's good. It's really good, yeah.
It's much more general than just like pre-approval, but like how involved should the agent be with the lender information-wise?
So there's limits to what we can give you.
Yes.
And just because there's privacy rules. From my standpoint, I'm going to basically communicate with you and say like, hey, this is what they're good up to, and then this is where they want to be. Because there's, when I talk with clients, I always say there's two different numbers we're going to go over. There's going to be your max, and then there's going to be what you're comfortable with. And we have to find both, so you're aware of both. We'll tell you what those numbers are. If we're in the pre-approval process and the client isn't, getting us stuff, we can let you know like, hey, we're trying to get this done, but, we need this documentation. And quite frankly, it's good to have you guys as partners because we may need your help in convincing the client like, hey, Tony's not trying to be a pain here. He just needs this because he wants to make sure that you're solid and that your time isn't being wasted. Your time is in the client's. We want to protect our buyer's earnest money, right? We're representing the buyer. We want to protect their earnest money. We want to make sure this transaction closes. So, that's when we made Loopy in there. Eric, any questions about what I just covered there?
Nope, I'm good.
We're going to chat a little bit about initial disclosures versus final numbers. So when initial disclosures go out, they go out on what's called a loan estimate. And a loan estimate is exactly that. It is an estimate because we don't know exactly what homeowners insurance costs are going to be. We don't know exactly what title is going to charge. We don't know, necessarily exactly how much property taxes are going to be taken out. What's going to be prorated, what's not, because every contract is different. So we give a loan estimate that goes out and that goes to the borrower, and all that borrower is doing is by signing it, is they are saying, yep, I understand this is the estimate and I'm willing to proceed. it's not a final thing. That's a question that I get a lot from clients, is by signing this, is this locking me into something? No, it is not. A loan estimate is merely an intent to proceed. The difference between a loan estimate and a closing disclosure, there's many things. Number one, first off, neither one is binding and makes someone required to make a purchase. That's what the purchase agreement is. That's not what the loan estimate or closing disclosure is. But on a closing disclosure is going to be more dialed in. A closing disclosure is also going to break down what items are paid at closing and what items are paid before closing. Where that's relevant is like appraisal fees. Many appraisers, actually 99% of appraisers now, are requiring that appraisals be, the appraisal fee be paid up front, because they want to make sure that they're compensated for their work. So they're not going to go out there until appraisal fees are collected. So in a loan estimate, it'll show appraisal fee, a client will pay for it, and then on a closing disclosure, it will show that that appraisal fee is paid outside of closing, where some clients may, I don't want to say struggle or get confused, is they'll say like, oh, am I being double billed for this? The answer is no, you are not. It's just shown one way on a loan estimate, and shown differently on a closing disclosure. They'll never be double billed for it, but that's probably one of the biggest questions I get in closing disclosures is, am I being double billed? I already paid for this. Any cost associated with buying a home has to be listed on the closing disclosure. So that's why it's listed even though it's paid outside of closing. So just the general process, like start to finish of how this works, right? Someone fills out an application, they get pre-approved, you get them under contract, and then what happens next is once they're under contract, we're going to submit the file to underwriting. And all the underwriter is doing is they're taking a look at the work that I did, or the loan officer did, and they are making sure that I did my job correctly and making sure that this person is financially capable of closing on this loan within the guidelines of conventional FHA, VA, USDA, or whatever else program there is. That's all they're doing. It is very common in underwriting for us to submit a file, have the underwriter conditionally approve it. We'll grab some more documents because they're going to ask for a few more items. It's common that there's a couple rounds of underwriting, a little bit of back and forth. It's very, very common. But we go through underwriting, we do a couple rounds of it. Our processors will be in touch with the clients, and they will be grabbing additional information. And then once all that information is provided to the underwriter, we get our clear to close. During the underwriting process, we're also ordering the appraisal. If an appraisal is required, sometimes it's not required if we get an appraisal waiver. Appraisal waivers, typically, you get an appraisal waiver, I don't want to say typically you get, because they're becoming increasingly more rare. But typically appraisal waivers are 20% down or more. It is possible to get an appraisal waiver at 10% down. I just had it happen for the first time this week and I was super excited. I've never seen it happen before. But appraisal waivers are great because basically what the data aggregators are saying is they have enough data in that neighborhood to say that, yeah, that's a good price for that house. We don't need an appraiser to go out there and verify it. Appraisal waivers only exist on conventional loans. FHA and VA loans, there will always be an appraisal. Let's see here. I feel like I'm skipping around a lot already. But yeah, appraisals get in, they're just confirming value of the house, they're making sure that the house is safe and habitable for the buyers. And once those things get signed off on by the underwriter and everything else is turned in, we get our clear to close. When clear to close happens, we all do a happy dance because we're getting there. We'll start our final balancing with title probably about a week or so before the closing date, and by final balancing I mean we're just making sure that our numbers align with title so we can come up with that final cash to close number for the buyer. any questions on the process, what's involved with underwriting or anything?
Yes. I'm not coming from a mortgage or
That's okay.
real estate background,
that's
so
what
I wanna
I'm-
make sure I know
That's what I'm
this,
here for.
because it helps me with my recruiting. Okay, steps to getting approved. So you get the pre-approval, then you go to contract,
Yep, so.
and then, yep, go ahead.
Yep, so you get pre-approved,
Yep.
and then buyer and agent go out and they look at houses.
Oh, that's when, so not after the contract.
Yeah, in my opinion,
Uh-huh,
pre-approval should happen
okay.
before,
They won't
before
waste their
showings.
time if that person is not pre-approved.
They-
It's not
in
like the
my- In my
80s.
opinion, they should not.
Right, you guys,
Which is a little different, like, on the normal, yes, I 100% agree. But as a new agent, and the buyer client I have that wanted to go see that farm, he's not pre-approved yet. We're working with a lender, he's got all this stuff going, all that, he's not pre-approved. He's also a friend. So, we wanted to reignite his enthusiasm for wanting to buy a house, but also get some experience of showing a house and being like, okay, like, this is crazy, or, okay, this is more like this is normal. So that's the only thing I see differently, I'd say.
Oh, for sure.
yeah.
And there's
Sure.
way more than one way to do it.
Yeah.
I'm not saying that my opinion is right or wrong.
Yeah,
I'm just a very firm believer in like,
yeah.
Anybody
Ducks
else,
in a
yes, I
row,
agree.
Yeah.
generality, so
yeah,
this
let's,
is,
let's get
okay.
our ducks in a row. You know,
Okay.
There's definitely more than one way to do it.
so bear with me, Eric, because I know this is so probably basement knowledge for you guys. Okay, so
It's all good.
you guys, in general,
Mhm.
agents only start showing and going out with the clients when they're pre-approved, because they need to know the range, right? You don't know the range until you're pre-approved.
I don't wanna say that's in general, I think that's up to the agent on how they want
Okay,
to,
gotcha.
conduct their business.
Okay, right,
If you're writing an offer, it makes it so much stronger if there's a
Yeah.
strong pre-approval in the offer,
gotcha.
basically.
Yeah.
Because if somebody's writing an offer and there's no pre-approval letter in there, then you're like, are you even approved for this amount of house kind of
See,
thing, you
that's
know?
what I'm trying to
You don't have to fall in love
understand.
with something they can't.
Correct.
That's what
yes.
that's what I'm trying to understand. Okay, gotcha. So then is that the contract part where you're now under contract?
Yes.
Yes.
Okay, gotcha.
Yes.
Then it goes to the underwriter.
Yeah, so once we're under contract,
Yep,
then we will submit things to the underwriter.
okay. And the underwriter's just there to check to make sure that you, the loan officer, said they did things correctly and that,
Yep.
the valuation is correct, the process is correct.
Correct.
And you may have to go back and forth if they see discrepancies or if they don't quite understand something back and forth.
Correct.
Okay. Does the processor speak to the mortgage or to the agent or what does this processor speak to?
So the processor will interact with the client
There
to
you go.
gather some documentation.
Yep.
They may reach out to the agent to get like an updated, if there's like an amendment
Okay,
needed, or, if there's just a little like earnest money received, that's something that's, we have to collect to show that earnest money has actually been received and has come out, so we may reach out to the agent for that.
yeah,
But the processor's job during the mortgage process is to basically gather all the paperwork
oh,
that is outstanding
yeah,
and collect it and get it into the underwriter so we can get things closed.
there you go, there's my gap, that's where my gap is. And then you're ready for, that's clear to close.
Yeah, once
Once
we
we
get
get
into
the-
underwriting, we get
Yep.
everything that the underwriter requests, because the underwriter, when we initially submit it,
Mhm.
they are going to come up with something called a conditional approval. And the conditional approval is going to say, yep, we're going to approve this loan as long as this condition, this condition, this condition, and so on
Yeah.
is satisfied. And
Okay,
as we provide those conditions to the underwriter, they're gonna clear those conditions off the list.
okay, got it,
So a conditional approval, think of it as like a chore list.
sure.
These are your chores. Once
You don't
your
get
chores-
candy until
Yeah,
you clean
exactly.
your room, clear out the garbage, and
Exactly.
sweep the basement. Got it.
Exactly.
Okay, that helps. Got it. Okay.
Eric, how you doing back there?
Doing good.
Any questions from you?
Nope. I'll speak up if I do.
Alright, sounds good. I just wanted to check in on you so you know I'm not forgetting you.
Okay.
Some common problems in a real estate transaction from a lender's perspective. So, I try and make things very, very clear for clients on what not to do, but sometimes they do things anyways. So these are some conversations to have with clients as far as, hey, you're doing this, we're working on buying a house, please, these are good reminders to have with clients. If a client takes out new credit, opens up a new credit account, that could negatively impact their ability to finance. The reason why is if they take out like an installment loan, buying a vehicle or, personal loan for whatever reason, that could kill their debt to income ratio. That could mean they have too much debt. If they close an installment loan, oftentimes when someone closes an installment loan, there's a temporary dip in their credit score. So that could impact their ability to qualify for a loan. If they quit their job, and don't have any income, that's not going to work. Or if they quit their job and have a new job, but that new job is like commission, so it's variable. If you go from a salary job to a commission job, we're not going to be able to use that income right away.
Don't you need twice as much income proof for commission versus like a standard?
So commission jobs, typically we need a 2-year average of that. If you are going from salary position to salary position, easy peasy, no big deal. If you're going from 40 hours a week full-time to 40 hours a week full-time, easy peasy, no big deal. But when you go into that variable income, where you're either commission or let's say that you're variable hours, 1 week you're 38, the next week you're 30, then you're 36, those are the things that kill deals. So, as you're talking with clients, a big thing to do is if you get like a hint that they're thinking about making a big change, or they're thinking about buying a new vehicle prior to closing, direct them to speak with the loan officer. Because we're gonna be the ones that are gonna be able to say like, hey, don't do that right now, you're gonna ruin this, or yeah, you can, you're gonna be fine. A client that's got, a debt to income ratio of like 20%, not a big, if they wanna buy a new vehicle, I'll just tell them, well, their credit score is 810, have fun, dude. Go right ahead, I'm not worried about it, that's not going to kill my deal. If it's a conventional loan where the debt to income ratio maximum is 50% and they're at 49, don't do anything, because if this is going to just put the kibosh to it.
Okay. What about moving money around?
Yes, that's another one. Another big one is moving money around. Basically anything to do with someone's income or finances while they're either pre-approved or under contract, before they do anything, they should be talking with a loan officer prior to making a decision about moving stuff around. Because when money moves around, we have to track it. We have to establish 2 months worth of tracking for where money is moved around, because we have to source it.
I need some clarification on that. Moving money around, meaning?
So let's say, for example, they cash out their 401k because they want to get cash,
Okay,
and they deposit it into a bank account without telling us.
okay,
That's fine, they can do that,
yeah,
but they're creating a whole lot more paperwork and
okay,
stuff that we have to track.
Yeah.
Because we have to track if funds are being used for closing, we have to track and document and source where all those funds are coming from.
sure,
If you get here's a big one. If you're getting a gift from a relative,
okay,
please don't have your client deposit it into the client's bank account, because now we have to do a ton of tracking. The best way to handle a gift of funds is for the relative to wire it directly to the title company. If it's wired directly to the title company, we don't have to do a darn thing.
Okay.
If it's deposited into the client's bank account, we have to get gift letters, deposit slips, copies of canceled checks. In some instances, we have to get the donors' bank statements, and they don't like that, they never do.
Okay.
It's a giant pain in the rear.
So in that situation, it's ideal for the relative to give directly to the loan,
To the title
to
company.
the title company directly. Okay,
And these are instructions that we do give clients.
Yeah.
But it is very helpful
sure.
for you guys on the real estate side to back us up and say, they're telling you this for a reason,
Sure.
we're trying to save you some heartache.
Okay.
Um,
Simply just because everything you do has to be tracked and documented. And
Correct.
it's just creating more paperwork.
Correct.
Yeah.
Yep,
And
there's,
gifts are super common, way more common than you would realize.
Sure. Okay.
the reason for the tracking too is it's simply it's money laundering.
Oh, sure, sure,
Because
sure.
a very easy way for money laundering is to money launder via real estate.
Okay. Oh, yeah, for sure.
So that's why it's a guideline across the board. I had a conversation with a client who had received a $300,000 gift and was upset that we asked to track it. And I'm like,
Why?
The conversation,
You know?
right, the conversation I had to have with the client is, here's the deal, dude. I know that you're not trafficking money or laundering money. I know that, you know that.
But you don't know about the person who sent it.
Well, even that, but the investor who insures that loan
Yeah.
doesn't know you.
Sure.
So, in order for this loan to be insurable, because guys, if we don't do our job correctly, so our loans, they get randomly pulled and audited.
Sure.
If we don't do our job correctly on these loans and collect conditions and clear them appropriately, we get fined.
Sure.
And we may even have to buy back a loan ourselves.
Yeah.
To the tune of hundreds of thousands of dollars. So believe me, if I could get away with just doing a loan and not collecting documentation, I'd be thrilled. I'd make so much money. It'd be great.
Yeah.
I'd be so happy. But I can't.
Yeah.
And if I don't do my job correctly, I could get fined, I could have to pay $100,000, and I'm also the sole income provider for my family, I could lose my license.
Sure.
That would suck. So, when we're asking for these things, we're not trying to be pains.
Yeah.
There's in a mortgage, in a normal mortgage, there's over, I wanna say, 362 points of debt that need to be collected to close a loan.
Sure.
So we're not doing it to get in anyone's business, we're doing it to meet the investor's requirements so the loan can be insurable and we don't lose our jobs. And this is because of what happened in 2008.
Ken also just had another one where they got married in the middle of the transaction and they didn't tell Ken. And so everything had to be written the day of closing in
Yeah.
her new name.
Oh, wow.
So if they get married or if they have life changes like that, they also need to know.
Okay.
That was just last Friday.
Oh, wow. Okay.
I mean, anything that if you could foresee it changing someone's life significantly, just run it by us first. We'll let you know.
Mhm.
Once the loan closes, if you wanna go buy a Ferrari, you have fun.
Yeah.
You go do it, take me for a ride.
But during this,
But during this, don't.
just don't rock the boat.
Same
Yeah.
with buying furniture for your new house, just run it by them.
Yeah.
Make sure that you're in the clear to do something like that and don't finance it.
I had a client in April. They were very nice people. They were super nice. They opened up a Home Depot credit card for $25 to get a promo on moving boxes. Their debt to income ratio was at 49.99, and that $25,
Take a dip.
we had to get them to pay it off right away. Moving boxes? Stop it.
Over $25.
Yep. So,
Gotcha. Gotcha.
any questions I can answer about that stuff before we move on to the next topics? Another common question that I get from clients is, when can a rate be locked in? So when rates can be locked in, once you get under contract, that's when you start talking about when a rate can be locked in. It's a conversation that is had between the borrower and the loan officer. It depends on so many factors. If I've got a client who is at their maximum debt to income ratio, tough cookies, you're getting locked in. Because I have to protect your loan, and the market is very volatile. It goes up and down and up and down. So, when a client's that tight on their debt to income ratio, they're probably gonna get locked in right away. The nice thing is some lenders, I know we do, have what's called a float down policy, meaning that if a rate is locked in and if rates improve enough, that the rate can be floated down. So work with a lender that has those, because it's really nice, because it protects the client's worst case scenario. You might have a question.
Yeah, over like what span of time that go down? Like just the whole duration of
Not during the duration of the loan, the duration of the contract, between when the contract, or when it's locked and when it's closed.
Okay, got it.
Yeah, great clarifying question, thank you.
But like what time frame is that? Like, I know that depends on when they decide to buy a house and all that, but say they take 6 months, 7 months to find a house that they wanna buy, does that still apply, or?
So the interest rate doesn't get locked until they're actually under contract to buy a specific house. So when you're pre-approved, you don't get like, this is your rate.
Okay.
And the reason why you don't get that is because the market is changing every single day. Reprices are happening every single day, several times a day. So like for me, when I talk to clients and I pre-approve them, I don't even tell them what the interest rate is, because there's no point.
Yeah.
Because
Okay.
So it's once the offer they have submitted is accepted,
that's when to have a time to talk
that's when you
about.
start that conversation.
Yes,
Okay.
because now it's applicable. Because the last thing that I want to do is, let's say that I pre-approve someone right now and say, hey, congratulations, your conventional loan is 6.25%. And then they don't buy it for 6 months. Because I've had clients who I've worked with for 2 or 3 years before they got a contract.
Sure.
Your rate is 6.25 right now. And then 6 months, something happens in the market, rates shot to 7. Well, they're just pissed. Well, Tony, you told me 6.25.
Sure.
Yeah, and then with the float, say it floats down,
Mhm.
will it float back up? Or
So-
will it stay at whatever the lowest was?
So if we lock in an interest rate, let's say that we lock in at 6.25, and then, while we're going through underwriting and everything like that, before we could actually close on the house, rates drop to 5.5. We can float down to that 5.5. It will never exceed that 6.25.
Yeah,
Oh,
but if
okay.
it floats back up to the 6.25,
Nope.
then back there.
No, if you float down to where it is in that current market condition, it's going to stay at that
That's the
5.5.
Oh,
Yeah.
But if
okay.
it goes to 6.5, you're not gonna go to 6.5, you won't
yeah.
exceed
It's
6.5.
only down.
It's
Yeah.
down.
Yeah, it will only go down.
Okay, I just didn't know if because the original locking was the 6.25,
Okay, so-
that if it went back up to that.
No, so
But-
when
So
a
when you
float
float
down,
down, it relocks.
yes, when you float down, it's a manual, the loan officer has to request it. If I'm requesting a float down, please float it down to,
Current market.
to current market condition. Now, if a rate improves by 1/8, is it gonna float down? No, that's not that market improvement.
Yeah.
Generally, you're seeing 1/4% or better. But you also have to understand too that interest rates are they're like a gallon of gas, okay?
Sure.
There's cost to get each interest rate. So you might see, 6.25 is gonna cost $1,000. And then the market improves and 6.25 now costs $500. So, common question I get is, oh man, I hear rates have gotten so much better. I mean, the rate itself hasn't gotten better, but the cost to get the rate has, like a gallon of gas.
Yeah.
So, that's kind of my
It's a really
favorite
good way to,
Yeah, that's my favorite correlation. You can either get a gallon of gas for, $2.50 or you can get it for $2.80.
Yeah.
Gallon doesn't change.
Yes.
Yeah.
Exactly.
The size of the tank does, okay,
Yeah.
gotcha. So if I were to ask you, when can a rate be locked in? Your answer is depends. I mean, it's not, it just depends. But if I have if I'm at that 49% debt to income ratio, I'm gonna pretty much get locked in. Because
Yes.
they wanna be secure,
Right,
they wanna insure, okay, got it.
yeah,
Okay,
I mean,
I mean, there's all these other factors, but in that case, you're gonna get pretty much locked in.
correct.
Yeah, okay,
Like, I
got
have a
it.
client right now who, we're closing in a couple weeks. They're very tight
Sure,
on their numbers.
sure.
We have very little wiggle room,
Yeah.
so, sorry, your rate's being locked.
Yeah, yeah.
Because I've seen market shifts in the last 2 years, like, a year ago, last September.
Yeah.
And this is very timely, the Fed was were cutting rates, interest rates, their federal funds rate. And those are two different things, mortgage rates and federal funds rates, we'll talk about that in just a second. The market had priced in a certain amount of rate cut happening. And the Fed's cut rates, but they didn't cut them as much as the market thought.
Mhm.
And last fall, rates shot up 0.5%.
Mhm.
So I've got to be able to protect my client to make sure they can buy the house that they love, right? So that's why when you've got those really tight debt to income ratio situations, I'm locking.
Mhm.
I'm protecting that client for that transaction.
Can they still qualify for that float type of loan?
Yeah, oh, absolutely.
Okay.
If an interest rate is locked and we've got market improvement, we'll float it down for sure.
But that has to be an option. Not every loan.
Not everyone.
Not everyone offers or that even is
Yeah.
even a possibility. Okay.
Correct. A lot of lenders do. I'm not
Yeah.
saying that we're like the only one.
Yeah.
I'm not gonna lie to you.
For the float down, do they still have to pay to get it down like you would like to buy?
That is investor discretion. That is lender discretion. We do not,
Okay.
Oh, no, go ahead.
we don't, but some lenders will charge for that.
Okay.
In terms of interest rate, I'm only doing this to you because we just did a video about this yesterday. So if you're seeing lenders out there that are offering it's a 5.3% interest rate, I just got somebody a 5.3% interest rate. What are they doing to
You are
Get-
in my head.
What are they doing to get it that low, even though interest rates aren't at
Yes.
5.25 right now? Or
What they're doing is they're being intentionally misleading to get business. So market condition right now is not supporting low fives interest rates, upper fours interest rates. What they're more than likely talking about, when you see a really low interest rate advertised, you have to look at what the fine print says.
Sure.
So what I'm seeing a lot of loan officers out there doing right now is, let's say like market condition is like 6.25, we're just gonna keep using 6.25. They're like, oh, great, guess what? You can have an interest rate as low as 5.25%. And they're talking about a temporary 1.0 buy down. And by what a temporary 1.0 buy down means is a 1.01. They're gonna, for the first year, they're going to reduce the, or lower your monthly payment, 1%, or based off of a 1% lower rate. So if market condition is 6.25, they're gonna base your monthly payment off of 5.25 for that first year. And then it's going to reset. It's very, very misleading.
Okay.
So what does that cost the client?
Yeah.
It's expensive.
Yeah.
There's thousands. And they'll say, oh, the lender will pay for it. I hate that. I'm telling you guys right now, nothing is free.
Yep.
Nothing. So I've had clients who have talked about, oh, lender paid buy downs, and I run pricing on them, okay? When there's a lender paid buy down versus a seller paid buy down, the pricing is very, very different. It is more expensive to the consumer. So back to that gallon of gas comparison, if you're looking at a lender paid buy down versus a seller paid buy down, a lender paid buy down is going to be, you're not gonna see the same price for that rate. The lender paid is going to be more expensive. You are essentially prepaying your own interest. I'm not a fan of buy downs unless the seller's paying for them. And quite frankly, I'm not a fan of temporary rate buy downs at all.
I really liked what you said yesterday in our video about adding to your monthly payments. So say that, like, you're gonna have, like, that'll be X amount more monthly payments for you.
So, talking about rate buy downs,
Mhm.
like in buying points, okay? I am not a big fan of paying more than $1,000 in discount points right now. And the reason being is because we are in a rate environment right now where it's very likely that in the next 12 to 24 months, if you've got a rate that's above 6%, you are probably going to be refinancing that to a lower rate. That is the rate, that's the environment that we are in. So when you are buying discount points right now, and you're spending several $1,000s to do so, you're not going to recoup that investment. You know, I did these numbers for a client just a few days ago. $450,000 loan amount, and they wanted to spend, I want to say it was right around $8,000 to $9,000 in discount points, and it was going to save them $145 a month. Well, I'm going to take my calculator here. Actually, is there a calculator? There might be a calculator.
There you go.
Beautiful. Eric, I hope you can see this calculator. I don't know if you can. But let's say that you're spending $8,500 on discount points and it's going to save you $145 a month. You take $8,500 and you divide that by 145, the amount in points versus what you're saving. That means you would have to make 58 payments to break even on what you are spending in points. And if you are going to refinance in the next 12 to 24 months,
That's 5 years almost.
yes.
Yeah,
So if you're refinancing in the next 12 to 24 months, well,
but you're still paying with it, okay, gotcha,
yes,
gotcha.
so you just basically threw away
Threw away
$6,000.
$6,000, yeah.
I'm really,
Yeah.
really encouraging people to not pay the exorbitant amount in discount points right now.
Yeah, thank you for bringing that up, because as I'm going through my recruit list, I'm seeing agents say, I can get you a rate at such and such, and I'm like, what?
And
You know,
so, general tangent here, I loathe talking about interest rates in general. And the reason being is because they are so subjective to every person's credit profile and financial ability. Like, I don't like rug pulling. I cannot stand pulling the rug, and I don't like it. So I would hate to have someone, I would hate to make a post and saying, hey guys, you know, we got this awesome blah, blah, blah rate for this client, blah, 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 blah. And then the client gets all excited and they're like, oh man, yeah, I'm gonna call you because you did this. And, you know, they've got like a 590 credit score and they need down payment assistance. Well, guess what? Now I have to pull the rug from them and say, yeah, you know, this person got it, but it's just not good.
Yeah.
So I just don't like talking about
Sure.
rates for that reason. Federal funds rate and mortgage rates. So those are two different things. You're probably hearing a lot of stuff in the news right now about, oh, the feds are cutting interest rates are gonna drop here at the end of the month. Well, I've got news for you. The markets have already priced in an interest rate cut. So what you are seeing right now in the market is what it's going to be at the end of the month, more than likely. Now, what could change that is, let's say that the feds, you know, they are factoring a 25 basis point rate cut right now. If the feds cut 50 basis points, you can see mortgage rates go lower. If the feds don't cut at all, anything at all, you're gonna see rates go up. That example that I brought up about last fall, they shooting up a half point, that's exactly what happened. So there's growing momentum right now for a 50 basis point rate cut. There's growing momentum for that. I don't think markets have priced that in yet. I think they are going to start pricing that in yet, or they're just going to start pricing that in soon. So we're gonna see basically if they do price that 50 basis point rate cut in, and then they only cut 25 basis points the end of the month, we're gonna see rates go up again. They're not gonna go up full percent, but they are gonna go up off of the lows that we're seeing right now. So while they do interact with each other, the federal funds rate is not what mortgage rates are. And I can guarantee you, I will bet you my house, I will sign the deed to you right now, if you wanna make this bet. I guarantee you that if the feds cut rates, you are going to see people in our industry saying, oh, interest rates are lowering, interest rates are cut, and they're gonna make it sound like mortgage rates are coming down, when in all actuality, they may not come down at all, and they might actually go up.
Sure.
We don't know. That would grab people. Just,
Yeah,
Lot of rate talk. What questions can I answer about that?
I had one, but it's gone.
If you have one,
I left the building.
So,
stop me.
I,
So you-
Well, no, literally, I just had it, and then you asked the question, and then it
and
was
you
like,
lost
"Bye."
it might just, yeah, it'll come back. So there is a confusion amongst consumers, right?
Mhm.
What the federal rate versus the mortgage rate. So I guess people just understand a blank general rates are coming from. I just always assumed it was always federal.
So federal funds rate, the Fed funds rate is more correlated with like your auto loans. And although mortgage-backed securities do correlate with it, they are not one and the same.
Sure.
So I just, the market improvement we have seen over the last couple of weeks, which has been fantastic, by the way.
Yeah.
You know, these are the best rates I've seen in 3 years.
Yeah,
Okay,
yeah.
so that's great.
Yeah.
You know, they're pricing in anticipating a rate cut. But if it doesn't happen, if the cut at the end of this month doesn't happen as expected, it's gonna go up or down depending what the cut actually is.
Sure.
That's just, people need to understand that.
In the spirit of 101, what's a mortgage-backed security, Tony?
That's good. Ask the questions I don't know to ask. That's good.
I'm just,
The mortgage-backed securities, I'm trying to think of a good way to explain this. I know how I understand it, but how I understand it is very convoluted. So,
metaphor. So are you trying to think of a metaphor?
I'm trying to think of, you know what, we're gonna chat GPT a good analogy for mortgage-backed securities.
There you go.
'Cause I like
No,
analogies.
it's the last one I was closed. Round? I was expecting you to get a different color before.
That's not a good analogy, ChatGPT.
That's not a good
That's not a
analogy.
good analogy at all. Basically, mortgage-backed securities are, it was a horrible analogy that ChatGPT gave me. Mortgage-backed securities, you're lumping a bunch of mortgages together, and banks can buy a little slice of each pie. The more mortgage-backed securities that banks buy, the more they own. Banks obviously make money off of them and trade off of them. I don't really have a good analogy for that one.
The next
Yeah.
Kahoot is on mortgage-backed securities, that's on the 25th, so.
Nice. Okay.
Let's see here, what else do I have? Closing time frames. So I would say average contracts are 25 to 30 calendar days. That's pretty standard. Can we close faster than that? Absolutely. I have closed loans in 8 calendar days before. It is possible.
I'm sorry, did you say 25?
25 to 30 calendar days is
Okay.
probably a pretty average contract.
30 calendar days, okay.
The big difference that you're going to see in contract time is when it comes to VA loans. So conventional and FHA loans, you can pay appraisers extra to rush the report and get it back sooner and bump up your time frame. VA loans, the appraiser has 10 business days from the date they have acknowledged or the date they have received the appraisal request to return the appraisal report. You can ask a VA appraiser to expedite, but they are not obliged to. They don't have to, and you can't pay them extra. So if you've got a VA loan and you need an appraisal on it, meaning an appraisal wasn't already done, then I would say a 3-week contract is your minimum. There are exceptions to that rule. I've closed VA loans in 8 days before on already completed appraisals. But generally 3-week minimum, you're gonna want on a VA loan. I'd say a 2-week minimum talk to your loan officer. Because, you know, there's things that we have to consider too. Like, if a contract, if it takes a 2-week close to win the deal for your client, we're gonna make that happen 100%. We've done that, I think, 3 times this month already. With that being said, I don't want to put stress on my team to close every single file in 2 weeks. That's just not good. Not good for our team or any operations team at all. Again, if that's what it takes to win it, we'll make it happen. But, you know, talk with your loan officer. We will relay those expectations to you. You know, I've seen, you know, typical, again, 25 to 30 calendar days. I mean, I've had loans sit for 6 months before because we're waiting on the seller to find a property that they like, and it's contingent on the seller finding a property they like. So we're just like, assumable loans. If you are dealing with an assumable loan, you know, VA assumable specifically, you know, you don't want to schedule a back-to-back closing and your VA seller who is doing the assumable is buying something back-to-back, because that's not going to happen. There's an entirely different process with an assumable loan that needs to occur. You're not doing a back-to-back closing on a VA loan. On a VA assumable loan, you can do back-to-backs on the purchases, not VA assumables. Any questions I can answer about average closing time frames?
It just always seems that with VA, there's just always extra time. Why is that?
The only extra, I don't even want to call it extra time,
Sure.
but the only extra time, quote unquote, is just for the appraisal to come in.
Okay.
I mean, you know, conventional loans can also take 10 business days as well to get appraisals in, same as FHA loans. But VA loans, with conventional loans, you can pay that appraiser extra to get it done faster. VA loans just can't do that.
Sure.
Some, you know, and again, VA appraisers, they don't have to rush the reports, but many will. I have one that we ordered on, what day is today, Thursday? We ordered it on Monday and we got the appraisal in last night. You know, there are great appraisers out there and they will help you. It just, we can't control them. So I don't want to set an expectation that we're going to be able to close on the VA loan in 2 weeks, you know, when there's a big factor in there that I don't control, right?
Okay.
But I very regularly close VA loans in 3 weeks,
Yep.
which is not an issue.
Wow.
So, you know, I see a lot of lenders out there who will say, oh, it's a VA loan, so we get, you know, 45 days. That's not a thing. That's a them issue. That's not a VA loan issue. VA loans can absolutely get closed 3 weeks or less. So.
You just have to have the #1 VA loan officer.
There you go. There you go.
But it's not even me. It's really not. Like the loan product is not, it's not a difficult product. It's really not. You just have to know the
You know
nuances.
this, yeah.
And that's it.
Yep.
I just, you know, when I hear loan officers bag on VA loans and how hard they are, that is a problem with that loan officer. It's not a problem with the loan.
Yeah.
It's really not.
I have a potential client who is holding out because he just got divorced and he wants to use a VA loan to buy his next house again, but he has to wait until he can get his wife's name off his house now. Because she also is a vet and they did it together, I don't know.
So he's probably referring to having enough available entitlement,
Maybe.
and I would say that might not be true. You may be able to buy now. It all depends on how much entitlement is charged. A veteran can have more than one VA loan at the same time.
Okay.
I've seen as many as 4.
Because I don't think he knows that.
He probably doesn't, because there are so many myths out there about VA loans. And one of them is you can only have one VA loan at a time. That is absolutely not true. It all depends on remaining entitlement, and that's a calculation that we, and I can do
Because
that.
he would sell the house he's in now anyways, which would pay off that loan
Correct.
and get them off of it anyways.
Correct.
That's what I wasn't like, making sense to me.
referring to, he may wanna buy something now,
Yeah,
and that may very well be possible. And if he wants to, I'm happy to talk to him, and I can calculate that for him in a minute.
Okay.
That just needs to be a phone call with him. I need to grab 2 pieces of data from him to search it, and then I can run the numbers for him. And I'll let him know. But it's absolutely possible that he may not have to wait.
okay.
So,
Can I just in general, because I'm not married to someone who served, understand the VA loan itself? Is that, I understand this, but is it that they are privy to, I mean, what's special about the VA loan?
I'm glad you asked that question.
Yes,
Many things.
yeah,
So, in my opinion, the VA loan is the best mortgage product on the market. And there are several reasons why. First and foremost, the VA loan is an earned benefit, meaning that that person had to sacrifice, their family had to sacrifice in order for them to be able to buy a house with no down payment, with lower interest rates than FHA and conventional loans, with no mortgage insurance, and the most flexible underwriting terms of any loan product out there.
okay,
VA loans do not have maximum debt to income ratios. They work off of residual income. Underwriting guidelines are written specifically to benefit the veteran. The appraisal process, though the timeliness standard to turn the report in is a little bit longer than conventional or FHA. There are more built-in mechanisms to fight a bad VA appraisal than there are conventional or FHA loans. VA loans have 2 methods to fight a loan appraisal. Conventional and FHA loans, you have one, it doesn't work. I just last week had a VA loan where the appraisal came in $21,000 low, and I knew that appraisal was full of it because I have had issues with that appraiser. I was actually on the phone with VA about him this morning. We're handling it.
Yeah.
But
got a little agitated there a little
I was mad. Well,
just talking about it. Yeah.
Well, the appraiser flat out said to me on the phone, he said to me, home values are too high. It's my job to protect Americans and veterans.
Oh, good.
Okay.
So I said, okay, we're gonna handle this.
Yeah.
Appraisal came in $21,000 low. With the VA loan, you have 2 options. Number 1 is Tidewater. And in Tidewater, Tidewater is great because the appraiser, before they turn that appraisal in, they are giving you a chance to provide comps to support that purchase price. With Tidewater, the appraiser is reaching out to you and is saying, hey, I think this appraisal is going to come in low. Give me some comps to prove me wrong. So before they turn in their homework to the teacher, they're letting you look over their work.
Sure.
You provide the comps to them, and then if they still come in low, you get to do what's called a reconsideration of value. And that's when you get to go directly to the teacher. You go over the appraiser's head directly to the teacher, the VA, and say, hey, this appraiser turned it in and said that it's low. Here is all my reasoning why this appraiser is full of doo-doo. Please reconsider this. So we did this with this last veteran, and we got the purchase price increase $21,000 to meet appraised value, using the same comps that we provided the appraiser. So you can't do that with conventional or FHA loans.
Okay.
So that specific loan, had it not been a VA loan, that person would not have been able to buy that house. That is why it is the best mortgage product on the market.
Okay, you said 2, Tidewater.
And reconsideration of value.
This is the second one, perfect, okay. Nice.
Which brings up another quick topic. Okay. Loan types. So the big ones you are going to see are conventional loans, FHA loans, and VA loans. VA loans we just talked about, so I'm not going to beat that horse. FHA loans we'll briefly discuss. So FHA loans are also government-backed loans. They're backed by HUD. And where FHA loans really shine is if you have some folks who have a little bit maybe rougher credit, FHA loans are great for them. A little bit more lenient on credit. There is mortgage insurance that they're gonna have for the life of the loan unless they put down at least 10 or 11%, can't remember which one, I think it's 11. No, it's 10%, 11 years. I don't remember, I'm tired. But that's what FHA loans are great for. The reason why FHA rates are typically lower than conventional rates are because there is a backing by HUD. So if the buyer defaults on the loan, the investor will get paid a portion of that loan back. FHA rates, they have set mortgage insurance at 0.55%. Conventional loans also have mortgage insurance unless they put at least 20% down. Mortgage insurance rates on conventional loans, they change based off of financial profile, down payment, credit score, and everything. It's variable. FHA loans have a maximum debt to income ratio of 56.99%. Conventional loans, as I said earlier, they max out at about 50%. And then conventional loans, they're your most popular mortgage product type out there. Conventional loans are backed by either Fannie Mae or Freddie Mac. So Fannie or Freddie, those are the investors who back those loans. And when we go through underwriting, we are either underwriting to Fannie Mae standards or Freddie Mac standards. There are, differences of, when we may go Fannie versus Freddie, different employment situations, employment types. They have some different little nuances with them that I'm probably not going to get into the weeds about today. Big also determining factor on whether we go Fannie or Freddie is if I get an appraisal waiver. If I get an appraisal waiver on one versus the other, I'll go with the appraisal waiver. Because each one has different data sets that they use on whether or not they're going to allow for an appraisal waiver. Any questions about the different, USDA, I should probably talk about USDA. You'll hear a lot about USDA loans, and when I tell you about them, you're gonna be like, oh my gosh, why don't more people use USDA loans? And I'll tell you why. USDA loans are for more rural areas, and when I say rural, I'm not talking Baudette, Minnesota. We don't have to be that rural. Greer knows where Cambridge is. Cambridge is considered rural for USDA purposes. There's an eligibility map that you can look at and see what it falls under. But USDA loans don't require down payment, which is nice. There is a mortgage insurance. It's a little different than FHA mortgage insurance. They still have their normal closing costs and whatnot. But the biggest thing with USDA loans, and this is why they're not used as often, is because they have very strict rules about debt to income ratios. And there's buckets that need to be fit in. So on your front end debt to income ratio, and by front end we're talking about just the mortgage payment itself. Front end can't be more than 29% of the monthly income. Your back end ratio can't be more than, depends on financial profile, 41 to 43%. Back end means your mortgage payment plus all your other debts. So unless you fit in that specific bucket, which most people do not, you can't qualify for a USDA loan. So they are great in the very rare circumstances that they work. I want to say last year, a top 10 USDA loan officer in the country closed 8 USDA loans.
Wow.
That's how little that product is used. So, if you're in a rural area, it's something to definitely consider, but just keep in mind that it's going to be harder to qualify for because of that. Any questions about the different loan types and the nuances?
What's the lowest down payment you can have for the other loan products?
Lowest down payment for conventional, if you were a first-time home buyer or you fit within area median income requirements, is 3%. I will say, when it comes to pricing for both interest rate and mortgage insurance, if a client can put down at least 5%, there's benefit to them there. FHA loans, minimum is 3.5%. If your credit score is 580 or higher, minimum is 3.5%. If it's between 500 and 579, you're looking at a minimum of 10% down. VA loan, no down payment required, and USDA loan, no down payment required. Big myth for conventional loans, or a lot of first-time homebuyers have is, I don't have 20% to put down. You don't need to. I think back in the day, mortgage insurance was very, very expensive. So that's where that 20% down myth is kind of perpetuated from a lot of folks' parents. I've seen mortgage insurance cost $30 a month. For some clients, I actually have a client right now who's under contract, they're closing in a couple weeks. They were gonna put 20% down and it was going to deplete almost 90% of their savings. I said, guys, why don't we do 10% down so you have a buffer, you have good liquid savings, your mortgage insurance is $33 a month. To me, it doesn't make sense to put down a full 20%, exhaust your savings in your emergency fund to save $33 a month. That's $360 a year.
So Tony, I want to talk about that a little bit because there is that, you do hear, you hear people say, well, I need to have 20% down or this or that. And that's not necessarily true. That's coming from
That's just a home buyer myth.
it's a home, okay.
The only time that you will need to have that you would have to have a large down payment is if you needed to qualify for it for debt to income ratio purposes.
Okay, yep.
That's the only time. But the minimum for a first time home buyer on a conventional loan, minimum down payment's gonna be 3%. If you're a second time buyer and you don't fit under that area median income, then you're looking at 5%. But you do not need 20% down to buy a home unless for debt to income purposes, ratio purposes, you have to have it to be under that. Now, where I could also see hangups is if someone's buying a second home or an investment property, that's going to require a larger down payment. But for primary residence only, you do not need, you don't need to put down a large down payment.
Sure.
Any other questions?
What was the FHA one? I have the 3%, 5% is better,
FHA,
yeah,
if your credit score is 580 or higher,
there you go.
minimum's
80
3.5%.
3.5%, okay.
Between 500 and 579, you're looking at minimum 10%.
579, 10%, okay.
I know I just threw a ton at you guys. It's like drinking water through a fire hose. What, can I answer any questions? Is there anything that I didn't cover that you wanted to learn today?
Hey, Tony, I have a question for you.
Yeah, you exist.
He
I love it.
existed. Oh my god.
What do you got?
I've got a seller that's moving to Arizona. He's a VA loan currently. Do you guys service, do you service loans in Arizona or no?
Every state except New York.
Perfect, thank you.
We will never lend in New York because they have very weird rules that we are not going to mess around with, so goodbye.
Yeah.
But every single state except New York.
All right, thanks a lot.
And when you do that cross-state thing, you understand, Minnesota's gonna be different than Arizona, or not necessarily.
No,
And
there are nuances.
Yeah.
Yes.
Yeah.
But what's nice about what we have, specifically speaking to us, what we have set up is we have a concierge team that knows the rules in every single state.
yeah,
And we check in with them beforehand to make sure that we're dotting our I's and crossing the T's. Like for a VA loan specifically in Arizona, I know a big difference, and I don't want to call it big,
Yeah.
but like in Minnesota,
Yeah.
we don't have to do termite or pest inspections in Minnesota on VA loans.
Sure.
Because we get below freezing, so therefore we
Yeah.
don't have that issue. In Arizona, there's gonna be a termite inspection that we're gonna have to
Yeah.
order. There are little nuances like that,
sure.
and the biggest change that you're gonna see, in the different states is like how property taxes are collected is one, and whether the state is an attorney state or not. And by attorney state, I mean some states like Texas, they are an attorney state, And it takes longer sometimes to close a loan because an attorney has to look over everything and sign off on everything before it's closed.
Oh, so you're adding an extra person in
Yes.
there? Okay. Okay. Is that something that loan companies, I mean, that's how it is for every loan company, or does that
No,
make
that's-
you
yeah.
distinguish with what you guys are doing?
No,
Okay.
yeah, attorney state is not like an us thing, it's a state thing.
Yeah.
Anyone closing a loan.
Yeah, I meant the being able to operate through state.
Oh, I'm sorry.
No, that's okay.
No, so every company, they don't, you have to be licensed in the specific state.
Mhm.
So whether a company is licensed in that state is up to that company.
Is up to that company.
So
Okay.
not every company is going to be able to lend in 49 states.
Yeah.
If they want
The
to, they
majority
can.
of them don't.
So
Yes.
specifically Agent Plus and Mutual of Omaha, because of the marriage with that and Keller Williams, we have the benefit of every state with the exception of New York.
Mhm.
Yep, excellent. Okay, you know, I'm in
Pretty cool
recruiting
thing.
now. Yeah,
Right,
yeah, right. Okay,
All right. Any other questions?
bring on a Kahoot. I feel like I got some cheater notes and might win a little something, you know?
Awesome. Well, thanks for letting me ramble for an hour and some change here. I appreciate it.
Yeah.
We're here to help with anything that you guys need,
Yeah.
so don't hesitate to reach out, and have a great day.
Good job, Tony.
Thanks. Good job.
Thanks, Eric.
Thanks, Eric. He's out.